Have you ever stopped to wonder what actually happens when money crosses borders? In today's super connected world, banks aren't just a place to keep your cash safe anymore. Oh no, they've become these global data reporters for tax authorities. And it's all thanks to two little acronyms you're about to get very familiar with: FATCA and CRS. For decades, this was the billion-dollar question for governments all over the world. I mean, how do you track income when your citizens can just, pop it into a bank account in another country? This single challenge is the whole reason our global financial system has been completely rewired from the ground up. And that really gets us to our first big point. The whole era of quietly stashing money abroad to avoid paying taxes, well, that's pretty much over. The core problem these new rules are designed to solve is global tax evasion, something that was, for a very long time, made possible by this kind of old-school tradition of financial secrecy between countries. And right here, this is the fundamental shift. This is the absolute game changer. The old way of doing things, where bank secrecy was a default, it's gone. Finished. What we have now is a new default: automatic reporting. Now, this massive change didn't just happen by accident. It's really built on two incredibly powerful regulatory pillars. So let's go ahead and meet the two acronyms that are totally reshaping global banking as we know it: FATCA and CRS. So first up is FATCA. You can think of this as the American-made original. It was passed way back in 2010, and its mission was super specific: force pretty much every bank in the world, from Zurich to Singapore, to comb through their client lists and report anyone who qualifies as a U.S. person directly to the IRS. Okay, so the rest of the world saw what the U.S. was doing, and, they basically thought, hey, that's a fantastic idea. So the OECD went and developed CRS, the Common Reporting Standard. The easiest way to think about it is FATCA, but on a global scale. It's not just about the US anymore. It's this huge multilateral agreement where over 100 countries all agree to automatically swap financial data with each other. And this table here, it just lays out the key differences perfectly. You can see FATCA is a US law, laser-focused on US persons. Meanwhile, CRS is the global standard, and it's looking for residents of all the participating countries. Their methods are a bit different too. FATCA uses these one-on-one agreements, but CRS creates this massive interconnected web of automatic data exchange. Okay, so we've got the what and the why. Now let's dive into the how. How does your personal information actually make the journey from your local bank branch all the way to a tax inspector, maybe halfway around the world? It's a really fascinating data pipeline. The whole thing really breaks down into 4 key stages. First, the bank has to figure out who is reportable. Second, it has to extract all their financial data. Third, it submits that data to its own local government. And finally, in step 4, that government exchanges it with other countries. Let's take a quick look at each one. It all kicks off with identification. So when you open a new account, you'll have to fill out what's called a self-certification form, where you declare where you're a tax resident. But that's not all they do. The bank's IT systems are also constantly scanning all their existing customer data for what they call indicia. These are just little clues like a US birthplace or a foreign phone number that might hint that you're reportable. Based on all that, your account gets its classification. And the second an account gets flagged as reportable, the bank's systems jump into action. They automatically pull this complete snapshot of your financial life for that year. We're not just talking about your account balance either. It's all the income that account generated, every single cent of interest, every dividend payment, the whole shebang. And this really shows you the enormous technical challenge here. A bank's internal data is often, let's be honest, kind of a mess. It's spread out across dozens of different systems, all in different formats. To comply, all of that has to be pulled together, cleaned up, and then converted into this one single, highly specific XML file. It's a massive data engineering project. And that brings us to the huge challenge this creates for the banks themselves. You see, these regulations aren't just about policy papers and legal jargon. At their absolute core, they are massive IT and data integration projects. I mean, just try to wrap your head around the complexity. You've got IT teams that have to map data from all these old legacy systems into that one perfect XML format. They have to figure out how to validate tax ID numbers from more than 100 different countries, and each one has its own unique format. And to top it all off, the list of countries participating in CRS is always changing, which means the systems need constant updates just to stay compliant. This quote here really just says it all. You have to forget about banking law for a second and think of FATCA and CRS as technical blueprints for a mandatory global data network. Compliance isn't a legal problem, it's an IT project, period. So, why on earth do banks pour billions of dollars into these IT projects? Well, it's because the stakes for getting it wrong are incredibly high. This isn't just about ticking a box on a form, it's about avoiding absolutely crippling penalties and maintaining trust. Let's start with the big one, the FATCA penalty. This thing is a huge motivator. If a bank anywhere in the world fails to report on its U.S. clients properly, the U.S. government can slap a 30% withholding tax on certain payments that flow through that bank from the U.S. For a big international bank, that could easily run into the billions. It's a penalty that's designed to be so painful that compliance is really the only choice. And the pain doesn't stop there. Beyond that massive FATCA tax, there's the severe reputational damage that comes with being labeled as non-compliant. Nobody wants that. Plus, the local regulators in the bank's own home country can come in and impose their own sanctions for failing to meet their CRS obligations. It's like a triple threat. So, after all of this complexity, the data mapping, the XML files, the scary penalties, it's really important to remember the goal. All of this is designed to do just one thing: to pull back the curtain on offshore finance and give tax authorities a crystal clear view of the assets their residents hold in other countries. And this really shows us the direction things are moving in, doesn't it? We've built this massive global pipeline specifically for financial data. And that leaves us with a huge final question to chew on. In our world that's becoming more digital by the second, is this kind of total financial transparency just inevitable?